Guys, welcome to our channel. Before we get started, make sure to hit that like button. Also subscribe to our channel Save and Invest How to Make the Most Money in the Shortest Time, so make sure to watch the full video. 1. High-Yield Savings Accounts. Overview. A high-yield savings account at a bank or credit union is a good alternative to holding cash in a checking account, which typically pays very little interest on your deposit. The bank will pay interest in a savings account on a regular basis. Who are they good for? A high-yield savings account works well for risk-averse investors, and especially for those who need money in the short term and want to avoid the risk that they won't get their money back. Risk savings accounts are insured by the Federal Deposit Insurance Corporation, FDIC, at banks, and by the National Credit Union Administration, NCUA, at credit unions, so you won't lose money. There's not really a risk to these accounts in the short term. Though investors who hold their money over longer periods may have trouble keeping up with inflation, you can typically earn much higher interest rates at online banks than at national brick-and-mortar banks. Plus, you can typically access the money by quickly transferring it to your primary bank or maybe even via an ATM. Liquidity savings accounts are highly liquid, and you can add money to the account. Savings accounts typically only allow for up to 6 fee-free withdrawals or transfers per statement cycle. However, the Federal Reserve now allows banks to waive this requirement. Of course, you'll want to watch out for banks that charge fees for maintaining the account or accessing ATMs, so you can minimize those. Where to get them? Savers would do well to comparison shop high-yield savings accounts because it's easy to find which banks offer the highest interest rates and they are easy to set up. 2. Short-term corporate bond funds. Overview. Corporate bonds are bonds issued by major corporations to fund their investments. They are typically considered safe and pay interest at regular intervals, perhaps quarterly or twice a year. Who are they good for? Bond funds are good for investors who want a diversified portfolio of bonds without having to analyze individual bonds. They're also good for individual investors who don't have enough money to buy individual bonds, and the risk-averse should like them too. Risks. A short-term corporate bond fund is not insured by the government, so it can lose money. However, bonds tend to be quite safe, especially if you're buying a broadly diversified collection of them. In addition, a short-term fund provides the least amount of risk exposure to changing interest rates, so rising or falling rates won't affect the price of the fund too much. Rewards bond funds are collections of these corporate bonds from many different companies, usually across many industries and company sizes. This diversification means that a poorly performing bond won't hurt the overall return very much. The bond fund will pay interest on a regular basis, typically monthly. Liquidity. A short-term corporate bond fund is highly liquid, and it can be bought and sold on any day that the financial markets are open. Where to get them? You can purchase them at virtually any online broker that offers ETF and mutual funds. 3. Money market accounts. Overview. Money market accounts are another kind of bank deposit, and they usually pay a higher interest rate than regular savings accounts, though they typically require a higher minimum investment too. Who are they good for? Money market accounts are good for those who need their money in the near future and need to be able to access it without any strings attached. Risks. Be sure to find a money market account that is FDIC insured so that your account will be protected from losing money, with coverage up to $250,000 per depositor per bank. Like a savings account, the major risk for money market accounts occurs over time, because their interest rates usually make it difficult for investors to keep up with inflation. In the short term, however, that's not a significant concern. Rewards. The key reward for money market accounts is the interest you can earn on the account, and you'll also have the ability to access the money on short notice if you need it. Liquidity. Money market accounts are highly liquid, though federal laws do impose some restrictions on withdrawals. Where to get them? You can open money market accounts at many banks and credit unions. 4. Cash management accounts. Overview. A cash management account allows you to put money in a variety of short-term investments, and it acts much like an omnibus account. Who are they good for? A cash management account gives you a liquid cash account that allows you to access your money quickly, and it may pay interest on your holdings. Risks cash management accounts are often invested in safe low-yield money market funds, so there's not a lot of risk. In the case of some robo-advisor accounts, these institutions deposit your money into FDIC-protected partner banks, so you might want to make sure that you don't exceed FDIC deposit coverage if you already do business with one of the partner banks. Rewards: you can often invest, write checks off the account, transfer money, and do other typical bank-like activities. So the cash management account gives you a lot of flexibility. Liquidity: cash management accounts are extremely liquid, and money can be withdrawn at any time. In this respect, they may be even better than traditional savings and money market accounts, which limit monthly withdrawals. Where to get them? Cash management accounts are typically offered by robo-advisors and online stockbrokers. 5. Short-term U.S. government bond funds. Overview: government bonds are like corporate bonds, except that they're issued by the U.S. federal government and its agencies. Government bond funds purchase investments such as T-bills, T-bonds, T-notes, and mortgage-backed securities from federal agencies such as the Government National Mortgage Association, Ginnie Mae. Who are they good for? Short-term government bonds are good for risk-averse investors who want a very safe investment. Bond funds are good for investors who want a diversified portfolio of bonds without having to analyze individual bonds. Risks: these bonds are considered low risk. While bonds issued by the federal government and its agencies are not backed by the FDIC, the bonds are the government's promises to repay money. Because they're backed by the full faith and credit of the United States, these bonds are considered very safe. In addition, a fund of short-term bonds means an investor takes on a low amount of interest rate risk. So rising or falling rates won't affect the price of the fund's bonds very much. Rewards: U.S. government bond funds will pay a reliable rate of interest, though because of their safety, they won't pay as much as corporate bonds. Liquidity: government bonds are among the most widely traded assets on the exchanges, so government bond funds are highly liquid. They can be bought and sold on any day that the stock market is open. Where to get them? You can purchase them at virtually any online broker that offers ETF and mutual funds. 6. No-penalty certificates of deposit. Overview: a no-penalty certificate of deposit, or CD, lets you dodge the typical fee that a bank charges if you cancel your CD before it matures. CDs are time deposits, meaning when you open one, you're agreeing to hold the money in the account for a specified period of time, ranging from periods of weeks up to many years, depending on the maturity you want. In exchange for the security of having this money in its vault, the bank will pay you a higher interest rate. Who are they good for? Those looking for some access to their cash while earning some interest may find the no-penalty CD useful. A no-penalty CD may also be attractive in a period of rising interest rates, since you can withdraw your money without paying a fee and then deposit it elsewhere for a higher return. Risk: CDs are insured by the FDIC, so you won't lose any money on them. The risks are limited for a short-term CD, but one risk is that you may miss out on a better rate elsewhere while your money is tied up in the CD. The lack of a penalty helps mitigate this risk, however. If the interest rate is too low, you may also end up losing purchasing power to inflation. Rewards: the bank pays interest on the CD regularly, and at the end of the CD's term, the bank will return your principal plus the earned interest. Liquidity: CDs are typically less liquid than other bank investments on this list, but a no-penalty CD allows you to avoid the charge for ending the CD early. So you can dodge the key element that makes most CDs illiquid. Where to get them? You can find CDs at your bank, and they'll generally offer a higher return than you could find in other bank products such as savings accounts and money market accounts. 7. Treasuries. Overview: Treasuries come in 3 varieties: T-bills, T-bonds, and T-notes, and they offer the ultimate in safe yield, backed by the AAA credit rating of the U.S. federal government. Who are they good for? Buying individual treasuries is better for investors who know exactly what kind of bond they want, because the risks and reward differ by bond. Rather than buying the government bond fund, you might opt to buy specific securities, depending on your needs. Risks: as with a bond fund, individual bonds are not backed by the FDIC, but are backed by the government's promise to repay the money, so they're considered very safe. But inflation can erode the purchasing power of treasuries, and long-dated bonds are particularly susceptible to changes in interest rates. What do you think of our video? Let us know in the comments section below. If you enjoyed this video, make sure to hit that like button. Also remember to subscribe to our channel and enable notification, so you will be the first to know when we upload a new video. Thank you for watching.